In today's video, we are going to talk about the qualitative characteristics of useful financial information. Chapter 2 of the conceptual framework states that in order for financial information to be useful, it must be relevant and faithfully represent what it purports to represent. The usefulness of financial information is enhanced if it's comparable, verifiable, timely, and understandable. So this is the general idea of qualitative characteristics. Now we'll look at each one in a bit more detail. There are two fundamental characteristics, so let's dive into relevance first. Is the information capable to influence the decisions of users? So if information will change what you're going to do, then it's relevant. This way, entities can't just hide the bad results because it's important for decision making. This influence can occur through the predictive value or the confirmatory value. The predictive value means that after reading the information, are users able to form expectations about events from the past, the present, or future? For example, if profits keep increasing year on year, users will most likely predict that this is a trend and will probably continue. So this has a predictive value and therefore it's relevant. Confirmatory value means that after reading the information, does that allow users to confirm the evaluations they've done in the past? For example, users can compare expected cash flows with actual cash flows when financial statements are issued. Another concept of relevance is materiality. This goes back to the idea that if something is relevant, it will influence the user's decision, which means it's material. The concept of materiality is subjective and it requires professional judgment because each entity is different. For example, if you're a billion-dollar company and you make a loss of $2,000, no one would really care and it wouldn't affect decision making. But if you made a loss of $20 million, then that may be material and you'll want to investigate further. So materiality isn't an exact number. You have to understand the context within the entity to determine if it's material or immaterial. Together with relevance, faithful representation is also a fundamental characteristic. This basically means that financial statements should be able to tell the full story of an entity in that reporting period. In order to do that, information should be complete, meaning you can't just leave out the bad news and keep the good news. It should be neutral, you have to be objective, and error-free. It might not be possible to achieve all three, but that's what we strive for to produce a high-quality financial statement. Now we'll move on to enhancing characteristics. These are what help achieve relevance and faithful representation. Comparability. We want to compare with competitors and previous periods to analyze performance and trends. We also want to identify similarities and differences. So if someone is interested in investing in entity A or entity B, comparable financial information may help them decide. One thing to be careful of is that comparability doesn't mean consistency. For example, some may think that using the same method to calculate depreciation satisfies comparability. However, we're allowed to change our depreciation policy because that might lead to a more relevant and accurate representation of the asset. So consistency might help with comparability, but it's not the same thing. Verifiability. This means that if an independent observer can conclude that the information is faithfully represented, then verifiability exists. This can be done in two ways. Direct, meaning having source documents like invoices, or indirect, meaning we have to check the inputs and the processes used to determine the information. For instance, if we are determining that determining the value of a used car, the indirect method may involve using the mileage, the year, and model of the vehicle, and you might be able to find vehicles on sale in the market. It doesn't have to be exact, but as long as there is something to support those calculations and estimates, then it's still considered reliable. Timeliness simply refers to the need for information to be presented in time for the user's decision making. The less timely information is presented, the less useful information is for decision making. For instance, if a company issues their financial statements a year after its reporting period, then investors would find it really hard to assess whether they should invest in the company because the circumstances may have significantly changed since then. And understandability means being clear and concise because sometimes people write pages and pages just to distract you and trick you. And users of financial statements are presumed to have reasonable knowledge of business and economic activities. You don't have to train users as if they're beginners. So if you think some information may be difficult for users to understand, that's not a reason to exclude them from the financial report. So these are the enhancing characteristics which, combined together with relevance and faithful representation, will lead to useful financial information. I hope you now understand the basic concepts of qualitative characteristics for useful financial information.